Something just broke in a market that most people have never thought about, and almost nobody is talking about it yet. Deep inside London's bullion vaults, in a system that has quietly priced silver for the entire world for over a century, the physical metal that traders promise to deliver is disappearing faster than it can be replaced. Not in theory, not in some abstract chart, in actual bars, sitting in actual vaults, being pulled out faster than mines can dig new silver from the ground. And when a market that has functioned smoothly for generations suddenly starts showing cracks like this, history tells us it rarely stays quiet for long. I want to walk you through this carefully the way I would if we were sitting across a table and you'd ask me to explain what's really happening, not the headlines, but the mechanics underneath them. Because once you understand how this system actually works, you'll start to see why so many experienced investors are quietly repositioning right now, and why the psychology of the crowd usually catches on last after most of the move has already happened. Before we go further, I'd love to know where you're watching from and what you're doing with your own money right now. Drop a comment below. Are you holding gold, silver, or mostly cash while you watch all this unfold? I read these and it genuinely helps me understand what everyday investors around the world are thinking and worrying about. Let's start with the foundation, because you can't understand what's happening in silver without understanding the plumbing underneath the entire global financial system. Most people think of money as something fixed and stable. A dollar is a dollar, a pound is a pound. But money in the modern era is fundamentally an elastic thing. Central banks can expand it, contract it, make it more available or more scarce, largely through the tool of interest rates. When a central bank like the Federal Reserve lowers interest rates, borrowing becomes cheaper, which encourages spending, investment, and risk-taking. When it raises rates, the opposite happens. Borrowing becomes expensive, spending slows, and capital tends to flow towards safer, income-generating assets like government bonds. This single lever, the interest rate, is one of the most powerful forces in the entire global economy because it changes the opportunity cost of holding non-yielding assets. Gold and silver don't pay interest, they don't pay a dividend. So when interest rates are high, holding them means giving up the income you could have earned elsewhere, and that makes them less attractive to short-term traders. But when real interest rates, meaning rates adjusted for inflation, start falling or even turn negative, the calculation flips. Suddenly, holding an asset that doesn't pay you anything isn't a disadvantage anymore because everything else isn't paying you much of a real return either. This is the quiet, unglamorous mechanism that has driven nearly every major gold and silver bull market in modern history. Now layer inflation on top of that. Inflation is, at its core, the erosion of purchasing power, the slow realization that the money sitting in your bank account buys less bread, less fuel, less housing than it did a year ago. Central banks have a difficult, almost impossible balancing act. They need to keep inflation low enough that people trust their currency, but they also need to keep economies growing, and critically, they need to manage enormous piles of government debt. And this is where things get genuinely complicated, because we are living through a period where global government debt, especially in the United States, has grown to levels that create a very specific and very old problem. When a government owes an extraordinary amount of money, it is essentially three paths forward. It can raise taxes and cut spending aggressively to pay the debt down, which is politically painful and rarely happens at the scale required. It can default outright, which is catastrophic and almost never chosen by a nation that controls its own currency. Or it can quietly inflate the debt away, letting the value of the currency erode over time so that the debt becomes easier to service in real terms, even if the number on paper stays the same. Historically, governments overwhelmingly choose the third path because it's the least visible and the least politically costly in the short run. Economists sometimes call this financial repression, keeping interest rates below the rate of inflation so that debt holders slowly lose purchasing power without anyone having to admit that a default is happening in slow motion. This is not a news story. It has happened before many times. In the late 1970s, the United States faced a similar combination of high government spending, high inflation, and a currency under pressure. Investors who understood what was happening moved into hard assets. Gold rose from around $35 an ounce to over $800 by 1980, and silver saw an even more dramatic percentage increase. That wasn't magic. It was the market pricing in the fact that paper currency was losing its purchasing power faster than people had been told to expect. We saw echoes of this again after the 2008 financial crisis, when central banks around the world slashed interest rates to nearly zero and began enormous bond buying programs, what's known as quantitative easing, to keep the financial system from collapsing. Gold rose from around $700 to over $1,900 in the years that followed, as investors recognized that trillions of dollars were being created faster than the real economy was growing. Now let me introduce you to someone, I'll call him David, a 58-year-old engineer from the Midwest. the kind of careful, methodical investor who spent 30 years building a retirement portfolio almost entirely in stocks and bonds. David is fictional, but his story reflects a pattern that plays out again and again. In 2008, David watched his portfolio drop nearly 40% in a matter of months. He didn't panic sell, which was admirable, but he also didn't understand why it happened. So when the recovery came, he simply went back to doing exactly what he'd done before. Full exposure to paper assets, no hedge against currency debasement, no understanding of what the Federal Reserve's actions actually meant for the long-term value of the dollar. Fast forward to today, and David is again watching headlines about debt, deficits, and a straining bullion market, and he's asking himself the same question so many people are asking: is this just noise, or is this the beginning of something bigger? David's story isn't a tragedy. He didn't lose everything, but it illustrates something important. Understanding the mechanics behind a crisis matters far more than reacting emotionally to the crisis itself. So let's go back to London, because this is where the story becomes genuinely fascinating from a mechanical standpoint. London has operated as one of the two great global hubs for precious metals trading for well over a century, alongside markets in New York and increasingly in Shanghai. The London bullion market operates largely on what's called an unallocated system, meaning that most of the silver traded there isn't sitting in a vault with your name on a specific bar. Instead, it's a paper claim, a promise that the metal exists and can be delivered if requested. For most of history, this has worked fine because very few people actually ask for physical delivery. It's similar to how a bank doesn't keep every depositor's cash sitting in a vault. It operates on the assumption that not everyone will show up demanding their money at the same time. But every so often in every fractional system, enough people start asking for the real thing at the same time, and that's when the cracks start to show. Over the past couple of years, we've seen a persistent and unusual trend: large amounts of physical silver being pulled out of London vaults and shipped elsewhere, often to satisfy demand in places like India, China, and increasingly into industrial applications like solar panel manufacturing, where silver is a critical component due to its unmatched electrical conductivity. At the same time, central banks around the world, not just in the West, but notably countries like China, Russia, India, and several others, have been steadily increasing their gold reserves at a pace not seen in decades, according to data published by the World Gold Council. While silver isn't typically held by central banks the way gold is, this broader trend tells us something important about how major institutional players are thinking about currency risk, geopolitical risk, and the long-term reliability of the US dollar as the world's reserve currency. This is where geopolitics enters the picture, and it's important to understand this without falling into sensationalism. When a country's central bank buys gold instead of holding US Treasury bonds, it's making a statement, whether intentional or not, about diversification away from dependence on any single currency system. This trend has accelerated noticeably since 2022, following the freezing of a significant portion of Russia's foreign currency reserves in response to the invasion of Ukraine. That single event sent a signal to central banks around the world that dollar-denominated reserves can, under certain political circumstances, become inaccessible. Whether or not you agree with the sanctions themselves, the economic lesson wasn't lost on finance ministries from Beijing to New Delhi to Riyadh. Reserves held in gold, sitting in your own vault, cannot be frozen by a foreign government. That is a powerful, sobering incentive, and it helps explain why gold buying by central banks has remained elevated for several consecutive years now. Silver sits in an interesting position because it's both a monetary metal with thousands of years of history as currency and an industrial metal essential to electronics, solar energy, and medical technology. This dual identity means silver demand is being squeezed from two directions simultaneously: investors seeking a hedge against currency debasement and industries that physically cannot function without it. When both of these demand sources rise at the same time that mine supply struggles to keep pace because new silver mines take years to develop and permit, you get exactly the kind of structural tightness that shows up as vault withdrawals and rising lease rates, which is the cost of borrowing physical silver for a short period. When lease rates spike, it's the market's way of telling you that physical metal is becoming scarce relative to the paper claims outstanding on it. Let me tell you about someone else. I'll call her Priya, a 34-year-old small business owner from outside Toronto. Priya isn't a professional trader. She runs a bakery. But a few years ago, after watching her supply cost rise relentlessly while her savings account barely kept up, she started reading about monetary history almost as a form of self-education, trying to understand why everything felt more expensive even though her income had grown. She didn't make a dramatic bet. She simply began allocating a small, consistent percentage of her savings, something like 5 to 10%, into physical gold and silver over a period of 2 years, treating it the way someone might treat an insurance policy rather than a speculative trade. She wasn't trying to get rich. She was trying to preserve what she had already worked for. Priya's story matters because it illustrates something the most experienced investors understand deeply. This isn't about timing a dramatic top or bottom. It's about steady, unemotional positioning based on understanding, not fear. Now, before we go further into what this all might mean, I want to pause and ask you for a small favor, because if you're finding this valuable, it genuinely helps if you hit like and consider subscribing, not because I need the validation, but because this channel exists to help everyday people understand these mechanisms clearly, without hype, and the algorithm rewards channels that people trust enough to come back to. And I genuinely encourage you to stay until the end here, because everything we've discussed so far, the interest rates, the debt cycle, the central bank buying, the London vault story, all of it connects into one final insight that ties the entire picture together, and I think it's the most important part of this whole discussion. Let's talk now about the psychology of all this, because markets are not simply mathematical systems. They are deeply human systems, and understanding human behavior is just as important as understanding monetary policy. There's a fascinating body of research in behavioral economics and neuroscience showing that our brains process financial fear and financial greed through some of the same ancient neural pathways that once helped our ancestors survive physical threats. When markets fall sharply, the amygdala, the brain's threat detection center, activates in a way remarkably similar to how it would respond to a physical predator. This is why panic selling during a crash often feels less like a rational decision and more like an uncontrollable urge to escape danger. Our biology, shaped over hundreds of thousands of years for physical survival, simply wasn't built for the abstract, slow-moving threats of currency debasement or bond market stress. On the flip side, greed activates the brain's dopamine reward system, the same pathway involved in other forms of anticipation and pleasure-seeking. This is why rising markets often become self-reinforcing in the short term. People see prices going up, their brains register a reward signal, and they buy more, which pushes prices higher still, right up until the point where the fundamentals can no longer support the enthusiasm and the cycle reverses sharply. Understanding this isn't just academic, it's practically useful, because if you know that your own brain is wired to panic at exactly the wrong moment and get greedy at exactly the wrong moment, you can build systems and rules for yourself in advance when you're calm, rather than trying to make good decisions in the middle of an emotional storm. This brings me to a third story, and this one carries a slightly harder lesson. I'll call him Marcus, a 26-year-old who got into trading during the enormous market volatility of 2020 and 20. Marcus made real money during that period, riding momentum in various speculative assets, and like many young investors during that time, he began to believe that his success reflected skill rather than an unusually favorable environment. When markets began to normalize as central banks raised interest rates aggressively starting in 2022 to fight inflation, Marcus held on too long, convinced that the same momentum would return, and he gave back a significant portion of his gains, along with money he could not comfortably afford to lose. Marcus's story isn't included to embarrass him, it's included because his experience is remarkably common, and it illustrates a crucial lesson about the difference between speculation and long-term wealth preservation. The investors who tend to do well across full economic cycles are rarely the ones chasing the fastest moving asset. They're the ones who understand the underlying macroeconomic forces at play and position themselves patiently, adjusting gradually rather than dramatically. So let's bring all of this together, because I promised you this would connect, and I meant it. We have a global debt load that is historically large relative to the size of the world's economies. We have central banks that face immense pressure to keep interest rates lower than the rate of inflation over time, because the alternative, honestly confronting the debt, is politically almost impossible. We have major world governments diversifying their reserves away from a single dominant currency, partly for economic reasons and partly because of the geopolitical lessons learned from recent conflicts and sanctions. We have a physical silver market where industrial demand, driven by genuine technological necessity, is colliding with investment demand, driven by a growing recognition of currency risk, at the exact same time that mine supply is structurally unable to expand quickly. And we have a paper trading system in London that was built for a world where very few participants ever asked for physical delivery, now facing a world where more and more of them are. None of this on its own guarantees any particular price outcome, and I want to be honest with you about that, because anyone who tells you they know exactly what silver or gold will do next with certainty is not being straight with you. What we can say, based on evidence and historical pattern rather than prediction, is that we are seeing the classic ingredients that have preceded major shifts in how capital is allocated across the world before, not identical to 1980, not identical to 2008, because history never repeats in exactly the same form, but rhyming closely enough that it deserves serious attention rather than dismissal. The final insight I want to leave you with is this, and I think it's the most important idea in the entire video. This isn't really a story about silver. Silver is simply the pressure valve, the place where the strain in a much larger system happens to be showing up most visibly right now, in the same way that a small crack in a dam is not really about that one crack, it's about the pressure of the entire reservoir behind it. The real story is about the slow, decades-long tension between government debt levels that keep growing and a monetary system that has to find some way to manage that debt without triggering a crisis of confidence. Throughout history, whenever this tension is built up, hard assets, those that cannot be printed, diluted, or created out of thin air, have tended to reassert their role as stores of value, not because of speculation, but because enough people, and eventually enough institutions, quietly conclude that paper promises are becoming less reliable than physical reality. That is the pattern. That is what the London Vault story is really telling us if you know how to listen. So what does this mean practically for you, watching this right now, trying to make sensible decisions with your own hard-earned money? It doesn't mean panicking. It doesn't mean liquidating everything you own and rushing into any single asset class, because concentration, even in something historically reliable like gold or silver, carries its own risks, and markets can remain irrational or volatile for far longer than seems logical. What it does mean is that understanding these forces gives you the ability to make thoughtful, gradual decisions rather than emotional, reactive ones. It means considering diversification not just across stocks and bonds, but across the full spectrum of assets that have historically preserved purchasing power during periods of currency stress. It means paying attention to real interest rates, not just headline rates, because that relationship tells you more about the true cost of holding cash than almost any other single indicator. And it means recognizing that the investors who navigate these transitions successfully throughout history have almost never been the loudest voices in the room. They've been the patient ones, the ones who did their homework quietly and positioned themselves steadily long before the rest of the crowd noticed anything was happening at all. We are, I believe, living through one of those slow-building, quietly significant periods in monetary history, not a dramatic collapse, not a conspiracy, simply the natural and largely predictable consequence of decades of accumulated debt, meeting a financial system that is being asked to absorb more strain than it was originally designed for. The cracks showing up in London's silver market are a symptom, a visible signal of pressures that have been building for a long time beneath the surface of the global economy. Whether this particular story accelerates quickly or unfolds slowly over years, the underlying lesson remains the same regardless of the exact timeline. Stay informed, not through panic-driven headlines, but through genuine understanding of how these systems actually work. Learn to recognize the difference between your own rational judgment and the ancient survival instincts your brain sometimes mistakes for financial wisdom. Avoid making dramatic decisions driven by fear or by greed, and instead build a thoughtful, diversified approach to protecting what you've worked so hard to build. The goal was never to predict the future perfectly. Nobody can do that, and you should be skeptical of anyone who claims otherwise. The goal is simply to understand the forces at play clearly enough that you can navigate whatever comes next with patience, with confidence, and with the kind of calm, independent thinking that has always separated those who preserve their wealth across generations from those who lose it chasing the next headline. Thank you for watching. Take care of your future, and I'll see you in the next one.